Welcome back. President Trump touting many of his economic accomplishments as the Democrats duke it out in the first presidential debate this week. First, the S&P 500 and the Dow are on track for their best Junes in decades. They are both up better than 6% for the month of June. Taking a look at low unemployment as well, 30-year mortgage rates have fallen to their lowest levels since 2016, and the unemployment rate is at a 51-year low. Joining me right now in an exclusive interview is the Federal Reserve Bank of Dallas President, Robert Kaplan. And Mr. President, it's always a pleasure to see you. Thanks so much for joining us.
Good to see you, Maria.
So we've got some very good metrics in terms of the economy right now, but you know that most people are expecting the economy to slow, according apparently to the Federal Reserve. How would you characterize things right now, and what are you expecting for 2019, sir?
So if I had appeared on this show on April 30th, I would have said that I was expecting growth in the U.S. economy for this year, 2.25%, 2.5%, and if I was wrong, I'd probably be on the low side. I'd expected growth from 2018 to 2019 to slow because of waning of fiscal stimulus, but we had pretty good momentum heading through the month of April. Then on May 1st and through May and then June, heightened trade tensions with China, and then the issues with Mexico and threatened tariffs there. And what I noticed from my contacts and all of our surveys at the Dallas Fed is companies started pulling back a bit on CapEx, and just the degree of uncertainty was enough to cause them to take a wait-and-see attitude. And so as I sit here today, our estimate at the Dallas Fed for GDP growth this year is now 2%. But the big change has really been in the last 8 weeks, and it's been due to heightened trade tensions and then feeding into that decelerating rates of global growth. The world is very reliant on trade. So those two things and the uncertainties associated with it have made growth more sluggish. Okay, so growth more sluggish. We just got the 3.1% number for the first quarter. Does that warrant interest rates to go lower? You know, there's all of this conversation that the Fed is going to be now cutting rates maybe 3 times in 2019. And I say, whoa, you know, we were just talking about 3 rate hikes 7 months ago. So, you know, I wrote an essay earlier this week where I basically said that I think it's too soon, for me at least, it's too soon to make a judgment about changing the stance of monetary policy. And the reason is that this uncertainty and this deceleration has happened just in the last 4 to 8 weeks. We've got the G20 here coming up. We have a whole month before the next FOMC meeting, the Fed meeting at the end of July. And I think it would be wise just to take a little more time and see whether it makes sense to change the stance. The other thing I'd emphasize, we're not restrictive right now at the Fed. We're, in my view, we're at about in the neighborhood of a neutral stance. We're not accommodative or restrictive. And the real question is, in cutting rates, we would become accommodative again. And is it really appropriate in this economy to become accommodative? And for me, I would need to see evidence of a more material deterioration in the outlook. I'm looking for it. I'm going to be vigilant to it. But I don't want to be cutting rates to do fine-tuning. I'd rather be adjusting policy if I thought there was some material deterioration. And that's why I want to take a little more time to see how events unfold. Yeah, so let's talk about where rates are right now, because, you know, we had a report out yesterday that Goldman Sachs, Ally Financial, beating the Fed to a rate cut. They're actually cutting their own rates. They say that they're going to be cutting the rate on the Marcus high-yield savings account to 2.15, down from 2.25%. That's Goldman Sachs telling customers yesterday. And then you just look at the 10-year. What are rates telling us today? So the rates for me are saying a few things. Number one, the curve is shifted down again just in the last 4 to 8 weeks. And that shift down tells me that there's a lot of global uncertainty. There's fears about sluggish outlook for growth, not only in the United States, but globally. And the other thing I think the curve is reflecting is maybe expectations of the Fed. There's a little bit of an echo chamber effect also, where people may be making judgments about what the Fed might do. And so the reason you may see some of these lowering of deposit rates is the 3-month Treasury has moved down. It's still, and it was upwardly sloping 3 months to 10 years 8 weeks ago. Today, it's actually inverted, and we're seeing sluggishness in the 2-year and the 5-year and the 10-year. But I think the question is basically, is this deterioration in the growth outlook going to persist? And I want to make sure that I'm not contributing to the movement in the curve. I want to let the economic events speak for themselves, and that's why, for the moment, I'm withholding judgment about what the right move for us to make is at the end of July.
And what metrics are you looking at closest? I mean, obviously, we're not seeing a lot of inflation. We just got the PCE index up 1.6%, exactly where everybody was expecting. But you mentioned the global story, and this is important because trade is the underlying issue here. How significant a slowdown have you seen in the global economies, and what's the most important metric that you're looking at to further decide?
Well, so I'm going to look at the next purchasing manager indexes done by the various regional feds. You may notice that New York, Philly, and our own Dallas index were sluggish in the most recent readings, but I'm being a little cautious about that because some of those sentiment readings were taken before Mexico issue got resolved. So I'm interested in looking at the next one. I want to see the next jobs report. I'm going to look at all our other indicators of what's going on in the economy. And for me, as a former business person, I extensively talk to businesses, not only in the 11th District, but through the country in various industries. And we do surveys of those businesses also. And I want to hear what businesses are saying. Right now, what they're telling me is, listen, we're very worried about trade uncertainties. We're worried about global growth uncertainties. But they're also saying to me, among all the things we're worried about, cost and availability of capital is not one of those things we're worried about. We've got very available capital at very low cost. We're worried about more fundamental issues away from monetary policy. And so I want to continue to have conversations with those contacts.
Which is why the banks passed the stress test, right?
Yeah, the banks are in. One of the bright spots is the banks relative to 10 years ago are in much better shape. Not perfect, but in better shape. And so it means in a downturn, they're going to be more resilient.
Very good.
And that's a positive.
Robert Kaplan, it's always a pleasure to see you.